And I think, if we're honest about it, one of the other things is that, the turtles, people who have educated themselves in the lore of trading, they know the turtles, they know the experience of the turtles and those kinds of, breakout and then trailing stop systems. And they know those kinds of systems generate, what they forget is they generate like win ratios of like 20%, but they will generate gigantic wins. So I think there's a little bit of that. And I think maybe there's also a little bit of like Warren Buffett syndrome where, people know that, that's a guy that hits some colossal home runs and like everybody wants that 10 bagger. But it's not the way, if you're an active trader, I don't think that's how you're going to get rich.
Welcome everyone to I'm sitting down with Adam Graham. Adam is someone I love to talk to for his approach on systematic trading, his approach on mindset, and it's kind of like calm and collected approach to trading. So Adam, welcome back on the podcast. I'll you here after a year that we spoke last time, and it's good to talk and catch up with you again.
Yeah, I'm very, very excited to be here. I always like to talk to people who are, you've walked the walk yourself. You started from scratch and you figured it out. You found something that works for you, and you're spreading the light to other people, and you're doing good work. And I'm excited to be here talking with you.
I appreciate you. Good to talk to you. So tell me, we talked I think like a year and a half ago or so. Tell me what's been going on since this last time. I know COVID is kind of behind a bit more now, but tell us about kind of what you're up to these days.
So I have one of my current big projects is I am working on a trading psychology book. And this has been an idea. I've had a couple books that have kind of been floating around in my head here for a couple years, and writing a book is a bit of a massive undertaking. I just can't quite bring myself to do it. But the two ideas I've been playing with are sort of maybe opposite approaches. A book on systematic trading, how to do the math, how to do the development for that, and then a book on trading psychology. And I really, over the past year, I wrapped up some of the music composition projects that I was focusing on. And we can talk about that too. I guess that's kind of another crazy angle. And I've really, over the past year, been focusing very intently on trading. Put myself, so, we do a lot. Tom, my business partner and trading partner, Tom Hansberry, and we do a lot of different kinds of swing trading. And that's really where my focus has been over the past 10 years. And I kind of wanted to go back to where I started. So I'm relearning, as it's a literal relearning process, how to day trade, how to be an intraday trader. And that's brought up some challenges, which I think are going to trickle through to the psychology book. I'm not sure if the first iteration of that book might actually be a course. So, the world will see that at some point in the future when I'm ready.
Definitely a lot to talk about here for sure. Now, tell me what made you switch from talking a lot about systematic trading and like a very clear approach, focusing on system, to kind of going more into psychology. Is it more like something you've realized over the past few years, or is it just you feel like there's a need for it?
Yeah, so I think trading psychology is a difficult subject because, as you know, like what's the most important thing in trading? Everything's important. If one thing is wrong, you're not going to be successful. If your exits aren't good, if your money management isn't good, if you're disciplined with taking trade, every single thing has to be important. So yes, trading psychology is critical because I think of it as the aspect that lets somebody, it removes friction, I guess. There are plenty of people systematic traders who have a great system, but they just can't push the button, or they'll start messing with their exits. They'll skip their stops, they'll take early exits, they'll take late exits, and all of that is where we get in the way of ourselves. And psychology in its proper place is helps get us out of the way. The problem is, I think, that a lot of people focus on psychology at the wrong point in the journey. And psychology itself is not an edge. If you can have the best trading psychology in the world, and if you don't have a system that has an edge, at best you're going to lose money slowly. So I've been a little reluctant to tackle the topic because it is I think it is possibly the most individual aspect of trading. And there are a lot of different things to talk about, everything from, mental fortitude and strength to meditation. I think even health and diet and, general taking care of yourself as a person, as a social animal, all of that falls into it. But then also, I think uh, my approach is always has a mathematical and statistical edge, even as a discretionary trader. And I think that a big part of trading psychology is that the problems that people have, they don't understand the impact of randomness. They don't understand the impact of, uh, if what would happen if you were to take random trades, for instance. People just don't know what that feels like. So I think they perceive intention, they perceive patterns in their trading results that aren't really there. So you really have to cover all of those things. And anything that I put out there, whether it's a blog post or a book, I really want to be very confident. I'm giving myself I find working on this project, one of the things I'm struggling with is giving myself the permission to make mistakes and to be wrong, because everything I write, I try very carefully to be precise and correct and as sure as I can. And a lot of this, you can't have that quite that same degree of confidence. So it's I was excited to tackle a new frontier in my work because it's focused so heavily on the statistical side.
Yeah, it's very funny you mentioned this because I see a lot of beginning traders who have no strategy. They have no clue what they're supposed to trade. That they heard somewhere psychology is key, so therefore they get a course in psychology. They want to learn psychology as much as they can and practice it, but they have no strategy and they have no consistency in the market because of it. So you're right that people kind of do it at the wrong time sometimes, or they hear that it's the key to like the trading success and everything. It's because of that they focus on just that and kind of forget the rest.
Yeah, and there are plenty of people, if you could imagine if your business were selling trading psychology advice, of course you would market it as it's the most important thing. I mean, I think at different points in people's journey, and I really have always thought of the process of becoming a trader, it's not something you learn. Like you really have to become a trader. You have to change yourself and become a trader. And I think for every trader, there's a point where psychology is really important. And it may not be those points, may not be expected points in the journey, but you'll definitely run into it. But yeah, it's, one of the things that I think about trading psychology, so many of the people that I've worked with and coached and mentored, my point has been you should have psychological problems with your trading. If you have a poorly conceived approach, if you have not done the work and have not done the back testing, you should not feel good about that. I worked with a trader who refused to do any quantification of his system because he believed very strongly in his intuition, which is fine. I suppose that could be a legitimate approach, but his numbers for several years were strongly negative. So, what I had to do as a coach was to really kind of grab him and say, "Hey, do you see this? Do you see that this number is less than this number, and that's your equity curve, and it's quite consistent." But my message to him was, he was like, well, maybe, he just wanted to work on psychology. And I said, you should feel bad about what you're doing. You're getting a clear message from the market that you're losing, and you should not feel good about that. So yeah, I think my approach to the psychology is going to be a little bit different than what you probably heard in the past.
Yeah, and same thing goes with discipline. Some people are looking for like the key to discipline and like being able to stay consistent with the strategy, like taking the right trades all the time. And I often tell them it's just a symptom for something else in the background that doesn't work well for them. So it's usually their strategy being wrong and they have rules missing or they have like something very vague that they just cannot follow. And because of that, they have no discipline, but it's just like the background kind of needs to be worked on.
Yeah, I think so. Discipline is one of those things that everybody likes to talk about it. And it sounds, it's we like to be very macho when we talk about trading, and discipline sounds really strong. And it sounds like, oh, of course, you just have to have ironclad discipline. And I think you're absolutely right. The reality is that if you have trouble with discipline, it is many, many times a symptom of something else. And the other thing that, on the discipline topic, one of my mentors said this to me. You know how I think at at the end of your trading career, you'll look back and there will be a few things that stand out. And, maybe, I don't know what, like half a dozen things that people have said to you. And this will be one of the things I always remember. He said to me, Adam, if you're not disciplined every instant you're in the market, you can't say you're disciplined. You can be a disciplined trader. You can do 40 trades in a row and do exactly the same thing. And then, I know where my Achilles heel is, and it's that I tend to take profits too early. And that goes way, way, way back to my initial formation as a trader, and it's something that I have defeated that. That's not a problem that I struggle with now, but I know that's probably what I'm vulnerable to. But so, I know I could do 40, 50 trades, and then on one trade, I get a little nervous or I'm having a bad day, and I take that profit early because I don't want to see the profit go away. I'm not a disciplined trader. You have to be disciplined every moment, every instant of your interaction with the market. And that's not, that's something to aspire to, but I think a beginning trader can't possibly hope to do that. And that's just a symptom of all of these other things that are, going on as all the pieces of their trading fit into place.
So how do you defeat things like overtrading, or like you said, not taking profit too early, or like taking profit too late, moving a stop loss? How do you defeat these kinds of behavior you have in trading? Is there a way, like a process to go through to reduce those, like push them away a little bit more?
All kinds of ways. One of the and a lot of these things are very simple. The solutions are so simple that you would not believe they would work. One of the things that I found to be very effective with traders is you put a rubber band around your wrist, and when you are about to make a mistake, it's a pattern interrupt. When you're about to make a mistake, you snap the rubber bands, you hurt yourself a little bit. It's not like you're whipping yourself or anything, but the pain of that rubber band, just before, like, if you, let's say for instance, that your weakness is you cancel stops. A lot of traders do that, right? It goes down to your stop, and then rather than getting stopped out, you're going to cancel the stop. And we know this is one of the very dangerous ways we can destroy accounts. So, what I would tell a trader is, okay, you can do that. But before you do that, snap the rubber band. And what you will find almost every time, the act of doing that just wakes you up enough to say, hey, I'm about to do something stupid. I'm not going to do that. I'm not going to push the button. So that kind of pattern interrupt can be a very powerful thing. Another thing that can be very effective, visualization is a powerful tool, but you have to use it correctly. And one of the best ways I know is to imagine a situation that causes you a lot of anxiety. So it could be, for instance, where that market is ticking down to your stop. We've all been there. I've been there several times today. And, how do you feel as it gets closer to your stop? So what you can do is, away from the market, you can sit in a quiet place. You can call it meditation if you want. You can do it. You can lie in your bed before you go to sleep, and you can imagine putting yourself in that situation. And then what I would encourage you to do is to create that physiological stress response. Make yourself breathe really fast. How do you breathe when you're scared? You breathe shallow, you breathe fast, and it affects the chemistry, the pH, and the balance of all the gases in your blood. And so make yourself do that. And what you can do is, away from the market, you can replicate the stress of coming down. What I'm using the stops just an example. Whatever stresses you out. For some traders, it might be taking an entry. It doesn't matter what it is. And then what you do is change your breathing to slow, deep, and relaxed breaths, and see yourself taking the right action there. A day of that, simply doing that exercise, takes maybe half an hour if you do it with intention. Do it a few times. It can have a profound effect on behavior. Another thing, what has worked for me over the years is different things work for different people, but for me, my self-talk is very brutal. Like, I will always, I'll say things to myself like, you're really a fucking idiot, which is not, if you're going to do that, are you stupid enough to do the same? And you could, what I'm describing in the wrong context could be a very destructive thing. It could, could be a spiraling cycle. But for me, my reaction to hearing myself say that is I kind of get angry at myself and I say, no, I'm not that stupid. I'm not going to make that mistake. And so very aggressive. And, it's almost like I joke with myself, I guess, but very aggressive, very negative self talk breaks me out of things. And the way that it was a persistent problem, gosh, 20 years ago when I was trading the S&P, that I would take my profits early. And the way I got out of it was at the end of the day, I looked at every trade and I simply made myself feel really bad every time I did it. And I, eventually got the message, kept telling myself, if you keep doing that, you're not going to be a trader. So you just know you have to change your behavior if you're going to stay in the game. A lot of different things for different people, but those are some things that work for me.
Interesting. It's kind of how also I kind of changed my bad habits too, right? The thought of, oh, if I'm not going to change this the right way, I'm probably not going to be a good trader. I'm probably not going to be a trader in the end eventually. So that's for me. That was a good thought, and I didn't really realize it, but that's exactly the thought I had a few years back. So it's very interesting to hear you talk about this.
And one of the things that I'm kind of playing with now, and I don't really know. This is the first time I've said this to anybody other than like two or three of the traders who are closest to me. So this is the first time this is going out in the world. One of the concepts I think that makes trading difficult is that one of the things that makes it difficult is that if we act like normal people in the market, like good, normal, sane people, we're not going to make money because the market is kind of a pathological environment. You have to do what seems and feels wrong. And I have found over the course of my career that a lot of times the areas that are causing me the most pain, that's what I should gravitate to. And in normal life, that's we use pain as kind of an away from thing, but I think in the kind of twisted way the market turns our own cognition, our own tools, our own emotions against us, and I really do think that's what the market does. The market is not random things moving around. The market is the changes of every market. The price changes are created by, it's a war, people fighting it out. And so those price movements encode human emotion, which means when we expose ourselves to them, particularly when we put on risk and those price changes do things to our trading accounts, it's I don't think it's a fully understood linkage. There's been some research showing that people can intuit intent, and intuit's not exactly the right word, but they can perceive intent. They can, tell when there's a manipulative trader in the market, and we feel this on some level. We feel this on some animal level, I think. And in this environment, a lot of times, what is our pain? What is our fear? Is actually something we should be going into, we should be digging into. And some of the real gems I have found in my trading experience have come out of not I wouldn't say face your fears. I wouldn't say make your fears go away. I would say go into your fears. You use them as like this beacon of this is an area you need to explore more. And eventually, the charge of all of this, I think, for those listening who are newer traders, part of the answer to all of the emotions we feel. I could tell you about my first few trades. I will if you want. That's kind of an interesting story. But all of these crazy emotions you feel do go away with repeated exposure. You get to some point after you've done enough trades that you're just like, nah, it's just another fucking trade. Like I'm not so involved with it. It does get easier, but it's this just this torrent of emotions for developing traders.
That's very interesting. I'll be curious to hear more about this, kind of how you've been able to do this, like go into your fears. Sounds very, very interesting and very similar to other stuff I'm learning and doing. So yeah, very curious to hear about like your perspective on this.
So it's really the word mindfulness is all over the place today. And I'm a little suspicious of that word because to me, I come from kind of a formal meditation background, and mindfulness means something very specific. But uh, let me use mindfulness like most people use it today. So what I mean is we're just paying attention, but we're paying a very special kind of attention, a very detailed attention to everything we do. So the first thing you have to do is you have to cultivate that kind of mindfulness or awareness of your own state. It's very, very difficult. Most of the things we're afraid of, we it's not that we don't want to face them. A lot of times we don't even get to that stage. We don't even want to be aware of our fears. So the things that we're really afraid of, where if you sit down and you think of like all the horrible things that can happen to you medically, unless you're one of those people who dwells on things like that, most people won't think about those things very much. As soon as you start to think about them, your brain does this like away from thing. So what you'll find with trading is that your your entire being will kind of wall you off from these areas of difficulty, these areas where there's some fear. So the first challenge actually is finding what those are for you. And I don't know any way to do it other than I think there are two ways to do it. One is just to trade for a long time, and that might not be profitable. You might be struggling for a long time, but eventually, no matter how hard we try not to, when the market punches you in the face enough times, you start to get the message. So trading for a long time is one way to become aware of our fears. The other one is cultivating this awareness, sitting down, doing some journaling, and say these are the aspects that are really difficult for me. And let's say, for instance, that this is not at all how I trade anymore. And we should talk about the 0.5R profit targets. I saw you interacting with somebody in social media about that, because that's also something that we've been looking at a little bit too. Um, but this is not how I trade. But let's say that you try to get these like gigantic wins. You try to get like 10, 15 times your initial risk. It can be done, just not very often. You can do it. And let's say that because I'm thinking of a specific trader I worked with who had this struggle, and he would, once he got beyond like 5 or 6R, he started to get very nervous. And I'm sure most people know what I mean by R, but it just means 5, 6 times your initial risk in the trade. So then he had very precise rules, trailing stop rules, that would get him out of a trade on a specific retracement at different brackets. It was well thought out, but he had difficulty that if there was a single bad day, he was trading on the daily chart, he would just get out kind of randomly if it was over like 5 or 6 hours. So what he had to do, once we had identified that that was a problem, he had to, when he was in that situation, really become very aware of his feeling. And then that's your chance to say, okay, now, it's one thing that we've done all of this, navel gazing, which is, I guess kind of a pejorative term, but we've done all of this like classroom academic work to figure ourselves out. But now you're standing in the arena and there's a lion in front of you and you have a spear in your hand, and it's quite a different thing. And there's no other way to replicate that except to be in the live market and to have risk. Now, the problem with this particular trader was he was trading, swing trading on a daily chart, and he really did not have that many trades. He had a handful of trades a month. So this is one advantage intraday traders have. He had to go many, many, many months before he could be, and of course, trading like that, you could trade for many months and not have a single trade go over 5 to 6 hours. So he had to work for a long time before he was in a position where he had a trade that had 8R, and then the thing had a bad retracement on a single day against him. And now what do you do? But because he had done all of that preparation work, he was able to act correctly. And the first trade happened, of course, it collapsed, and he would have been better off following his instinct. But that's also a good lesson from the market. The universe kind of throws us humorous curveballs like that. So I think I know it's kind of a complicated answer, but you really have to identify where your fear is, and then you have to actually seek it out, and you have to spend some time with it, and then you have to figure out how to shape your action, and all of these other tools come into play there.
Yeah, very good lesson there. And I think it's going to depend for everyone because, of course, not everyone looks for these 8R targets. But at the same time, it's interesting to kind of look at where you tend to kind of fall short and what things you tend to do or what things you tend to react to, and kind of trying to work on those things. So very good point.
Absolutely.
We got to talk about these targets. I'm curious to hear your thoughts on this. So you mentioned the targets. Are you looking for big targets, small targets, and what's your view on this?
I've changed over the past couple of years, and I don't remember if we talked about this. I certainly had changed by the last time we spoke, but over the years, I would use I basically trade. Most of my trades are retracement patterns and trends. I'll trade some breakouts. I don't really focus too much on support and resistance levels, but essentially, I'm looking for a trending market, looking for some kind of continuation, and I am there are things that we know we're good at. So this is going to sound arrogant when I say this, but one of my trading skills, I'm really good at trailing stops. I'm really good at setting trailing stops. And so what I would always do is take small profits. I would be aware of, here I'm at 1R, here I'm at 2R. I'll take some off. And I had this one glorious trade over 10 years ago. I still remember this. I made over 30R on a piece of a trade. It was a euro trade. Now the problem with that though was that I had taken profits on that damn thing about, I don't know, 8 times. So I made 30R on a very, very, very tiny piece of the trade. It was not much money at the end of the day. However, several things about that. When you have a trade like that, even if you have a small position on and it's a big R ratio, you're going to pay a lot of attention to it. And this is one of the dragons I have killed, but if I had not, I still remember that trade. It feels really good to make 34R on a trade. You feel like you're the king of the world. And of course, your brain very quickly forgets, oh, I made 34R on like 1/10 of my position. So I think it ties up too much of our too many mental cycles on these smaller things and smaller pieces. Many years ago, 5 or 6 years ago, I don't remember exactly when Tom and I started trading together, he was looking at my results. And he said, I think you might do a lot better if you took all of your profits at 1R. And I said, that's the stupidest idea I've ever heard. What a ridiculous thing. I'll almost always, it's not true, but my brain said that I'll get like a little bit off at like 3 or 4R all the time. And he's like, well, okay. And then, so we kind of let it sit there. And then I went back and I did some, pro forma. It's quite easy to look at your trading results and say, what would have happened if I took the whole thing off at 1R? And what I discovered was two things. So the first thing that we should not ignore is a smooth, all other things being equal, a smoother equity curve. An equity curve that goes like this is better than one that goes like this. So if you end up at the same place, if your equity curve has a lot more ups and downs, well, the smoother curve, one thing you can do, you can apply more leverage. You can take more risk. You can trade bigger. Again, all other things being equal and assuming that all the assumptions hold in the future, which is not always true, but it's a mental disclaimer that you always have to have going on. So it did smooth out the equity curve as expected. However, the other thing that surprised, just shocked me. It didn't surprise me, it shocked me. I would have made more money. So I would have had a smoother equity curve, lower standard deviation of returns, and a higher ending equity. And so we looked at other periods and other accounts, and like even records that I published publicly of trade setups and that had trailing stops, and we looked at them against a 1R target, and there was no doubt the 1R was over the top consistently better. So then you think, okay, well, like maybe 2R is a little bit better. That has not turned out to be the case. And this is one of the aspects of trading that I get the most pushback on from the most people. In fact, one of the things that I have a service where I do daily trade analysis and trade calls, and people trial our service, and a lot of the people that bounce from the trial and like it's not for me, one of the pieces of feedback I get from them is it doesn't make any sense. They say it doesn't make any sense to use a 1R target. I said, well, okay, I thought so too. Like, I understand where you are, but before I did about 200 hours of work by hand, I thought the same thing, and now I've seen the results. And as I have gone through this re-education, I think we were talking about this before the podcast, but my trading over the past decade is really focused on I'll say swing trading, but I really mean trades that I hold for like 2 to 10 days. So trading on the daily chart. Over the past couple years, I've migrated more and more intraday. We're doing more and more like 4-hour swing trading. And I decided in the middle of last year that I wanted to see in my mind, I don't know if this is true, other people might disagree, but I think probably the most difficult trading to do consistently at a very high level is to trade stock indexes on a discretionary basis intraday, to be a S&P or NASDAQ day trader. And because I did it years ago with considerable success, I wondered, could I do it again? And it's turned out, it's I've changed a little bit. The market's changed a little bit. This has been a kind of painful but very constructive re-education for myself. But one of the things that we have started exploring, which I have discarded, but one of the patterns that I was trading, we found worked very well with a 0.5R profit target. And the problem with that, though, with the way that I trade, is that sometimes the moves are so small that the execution matters for so much. I think if I were working from a purely algorithmic side, it would make more sense. But because, and again, maybe I'm going on 50. I don't have the reflexes I did in my 20s. Maybe part of it is me, but it ties me to the screen in a way that is a kind of lifestyle decision I don't want to do. But it does, it did verify to me that the 0.5R target makes sense. And also, incidentally, years ago when I was trading S&Ps exclusively intraday, my bread and butter trades, my risk was about 3 times my profit target. And, of course, the downside to trading like that is a losing trade takes a big piece out of a bunch of profits. But, it's certainly certainly a viable approach. And it's funny because it seems like every trading book you read, every guru, practically every tweet on the topic says you have to look for like a 1 to 5 ratio to your for your trades. I don't even know what that means. It makes no sense to me.
Yeah, what I heard a lot was like a 2 to 1. I feel like all the coaches have been saying this for years and years and years, looking for 2 to 1 target minimum. And like I've tried a bunch of things, and to me, it's always I always kind of go back between a like 1.5 to 1, very rarely more than that. Uh, since I posted this on social media last week, though, I've had a lot of people commenting that, oh, if you look for like a 1 to 1 or 0.8 to 1, then you've got more pressure to find good trades because they have to be like you have to be right more often than you're wrong. Or you have to like catch a good trades more often than you have losers. So do you have any kind of thoughts on how to be more comfortable with that feeling of like having to be right more often?
Absolutely. So, okay, this is totally cutting edge thinking. I I I typed to Tom today in one of our chats. Uh, I said we need to use a concept that maybe we would call like a null probability or a drift probability. So what this means is if you were to close your eyes and just hit the button and buy or short a market with a 1 to 1 profit target, no edge whatsoever. What you would find with that is that you're going to win 50% of the time. That system has no edge. You have no edge. Your win ratio is going to be 50%. And if you had a profit target that was twice as big as your risk, so a 2 to 1, well, guess what happens? You're still, it's almost, and it's not actually, you're going to be paying the bid ask. So, you are going to lose money if you try this stunt. It is one of the things I think traders should do. Um, People don't realize that simply setting that ratio affects your probabilities. This is the misconception people have. They think you have your probability and then you have your risk ratio. They don't understand that these things are intertwined and completely inseparable. So if you have an edge, uh, my experience is, I would say it's more than a belief because it comes from my experience trading and also a lot of statistical work. Patterns kind of have a forecast horizon. And what I mean, for those of you who might not have done this kind of work, let's imagine something like you have a. I'm going to give you two kinds of patterns. Let's imagine you have like kind of a complex consolidation pattern that sets up for many bars on whatever time frame you trade and then breaks out in the direction of a previous trend. That's example A. Example B is you have a market that comes up to some, define it however you want. I hate the concept. I never use it, but let's say some kind of overbought level and then comes down and then goes up to that level again and then collapses in a single bar. So what you would find if you were to structure those and test those, you would find that the second, because it's a smaller, in terms of the setup, it has a smaller window of effect. You would find that if you look, maybe like 3 to 5 bars, there's going to be a directional edge to that pattern. If we go out 15 bars, it's not there. If you're looking at the bigger picture consolidation, that will be a pattern that will have a larger forecast horizon. So you have to be aware of another way to say the same thing. Let's say you are trading I want to make this as universal for whatever markets people trade. Let's say whatever market you trade, you're trading a 2-minute chart and you're trading some little pattern on a 2-minute chart that takes maybe 5 bars to set up. Would it make sense to you if you took that and then you have your stops that are probably based off some kind of ATR of those 2-minute bars? That's how you're probably doing it. But if you took that pattern and then you use stops based on the weekly time frame, so that's not relevant at all. That you're reaching for too much. You've expanded your risk and your profit to the point where that pattern degrades into noise. So, and I know that was a little bit of a diversion, but as long as you're kind of within the forecast horizon where your pattern has power, uh, to some extent, you can choose your you can choose your win ratio by setting your profit target. So, by setting that ratio of your profit target to your risk. One of the ways that I will test patterns, a very quick and dirty way to test a pattern, is to just write it as a trading system and use a one-to-one profit and stop. And if that comes out consistently greater, that your profit is hit greater than the 50% of the time, then that pattern has an edge. I could perhaps trade it like that. What I might find is if I went like 1 to 4, it might still work, but my win ratio is going to drop way down. And, then there are other unattractive things. So I think that people don't understand. If you, let's say you're using that 0.5 R profit target, you, I would challenge you to trade with a profit target that is half the size of your risk, and you're absolutely going to win more often than you lose. And unless you're like getting out early, but you know what I mean. Just like if you're getting in and you're putting those two orders in, you're not going to be able to make exits where where you win 50% of the time. So by setting those ratios affects your probability. It's kind of basic math, but it's basic math that and one of the things that I'm very close to having is a set of exercises that will walk traders through how to do this in a very disciplined way. And the essence of it is, we do some work with like flipping coins and cards, which is abstract. And frankly, I don't think is that useful because your emotional involvement is absolutely zero. And then I have a very specific regimen of you putting on literally random trades with different variations of entry and of exit. Sorry, not entry, because they're random entries. But you're putting on actual trades, whether in a simulator or in the market, and you're using different exit strategies and seeing how that affects your probability. People don't understand that.
I think that the other big obstacle is people love to catch these big moves in the market. They love like being able to see on the chart, oh, I cut it from here to here. I caught that big move. Therefore, I'm a good trader. I think that's also the big obstacle.
Look at me. I'm still talking about a single trade I made over 10 years ago. People love to do that. And there's almost nothing that feels better than that. So you're right. It's a huge reinforcement. And I think, if we're honest about it, one of the other things is that, the turtles, people who have educated themselves in the lore of trading, they know the turtles, they know the experience of the turtles and those kinds of, breakout and then trailing stop systems. And they know those kinds of systems generate what they forget is they generate like win ratios of like 20%, but they will generate gigantic wins. So I think there's a little bit of that, and I think maybe there's also a little bit of like Warren Buffett syndrome, where people know that that's a guy that hits some colossal home runs, and like everybody wants that 10 bagger, but it's not the way. If you're an active trader, I don't think that's how you're going to get rich.
And especially with the way you trade, like the catching pullbacks, people expect you will be following trends and like catching the trends and riding these trends. So that seems to be very counterintuitive to just catch like a one-to-one or not more than that when you look for trends.
Yeah, there are. One of the ways I think the market has changed, and this is research that's still ongoing, but I think 20 years ago it was fairly possible to, well, I mean, let me not be so academic about it. I had sets of things that I would look for that told me that tomorrow was more likely to be an extended trend day. And they were things that everybody knows, like, compressed range. Toby Crabell's narrow range 7 was a good thing. Other things like, but all around that same concept of the market being very compressed. And my testing today shows that I don't think those edges are there anymore. I think that has come out of the market. So basically, in the past, it was possible for me at least, and maybe other people are able to do it. I mean, maybe I'll figure it out because, as I said, I'm still kind of putting the pieces of this new thing together. But it was possible, like I could come in and I could say, okay, today's a day that we're likely to see a big extended trend. So I'm going to try to hold on to pieces of these trades for that extended trend. Or I could say, today is going to be a choppy day. I'm going to take really conservative profits and be done with it. I don't have the same confidence based on both my statistical work and my very intense trading since the last quarter of last year. I've been doing this. It's like each day is a little bit more of a completely unknown new adventure, and you don't know, like you don't know. Um, so I think maybe without that degree of, it's essentially a higher time frame context and bias. If that's not present, then you probably are better off defaulting to the 1 hour trade. And what people don't, or 1 hour, perhaps even smaller in some cases, what the people who love, if you're one of the people who you're listening to all of this and you're, I know somebody's listening to this and you're thinking, okay, like these guys kind of sound like they might have some idea what they're talking about, but I still like to catch the 4 hour trade, so I'm going to do it, and it does feel good. I would tell you what you're not appreciating is also how good it feels to take 3, 4, 5 1 hour winners in a row, and to know that nothing can hurt me. And now I've just gotten in and out, and also the power of seeing that equity curve go up pretty, that's a pretty good reinforcement too. But there really is something, it's a harder sell. Catching those big wins feels good. It looks good on the chart, but there's also, I derive a tremendous amount of satisfaction from just taking these small trades. That feels really good too.
Yeah, you gotta attach yourself on that feeling of missing out too. Because if you see a move you cut 1 to 1 on and you see it go to 5 to 1, then that feels bad in the beginning. So that's the other aspect I guess you gotta work on.
Feeling that that's certainly one of the most common things, the FOMO, fear of missing out, and all of its different ways. And that's the big one, right? You took the little profit, and then the thing just collapses. And there's some part of your brain, no matter how good of a trader you are, how disciplined you are, there's some part of your brain that says, "Oh, I knew it." No, you didn't. No, you didn't. And had you, there's where you have to step in as a very dispassionate, very logical, and as much as possible non-emotional person, and say, you probably didn't know at that time, and anyway, you would have ripped up a ton of money on 15 trades trying to catch that. But yeah, that's the thing that you're going to struggle with when you start taking these smaller profits. And also, in my experience, the universe has a bit of a sense of humor. So if you're listening to this podcast and then you're going to go try to do this, I would bet your first trade is going to be one of those examples where you take the nice little 1 hour and then the thing just explodes and you're going to kick yourself. But stick with it. Like any change you make, you need to collect a reasonable sample of events before you can really evaluate it. So you want to get, several tens at least before you can.
And taking a more like data-driven approach, what would be the ideal, or I guess the target win rate you want to look for if you're going to catch these 1 hour targets?
The reality is net of, if you could eliminate friction, so you eliminate commissions, if you're trading 1 to 1, all you have to do to make a little bit of money is be right 51% of the time. Now, in reality, we make mistakes. We'll be a little bit early to, or, we'll be a little bit late to enter sometimes as a discretionary trader. You certainly have commissions and exchange fees. If you live in a world where you don't, I'd like to come into your world. But um, practically speaking, you don't have to have as high a win ratio as you think. You can make quite a bit of money with a win ratio around 55%. And some traders can coerce it, uh, depending on your pattern and time frame, a little bit higher than that. But you certainly, actually, I knew a trader who, over his career, he did focus on. It's not exactly the same thing because he was trading basically weekly charts, but he was using 1 to 1, and I think his win ratio was a little bit. Well, I guess the thing about weekly also is then the bid ask spread would basically be essentially nothing relative to the magnitude of his trade. So, uh, but I think his win ratio was about 53%. And he accumulated what by any means would be a significant personal fortune doing it. So, you don't, the idea that you have to have a win ratio of like 60% with a 1 to 1, I don't think it's true.
Yeah, definitely good lessons there. And I think we had a good discussion today. A lot of things that I didn't plan we would talk about, so that's pretty cool. Where can people connect with you or find out more about your work after this podcast?
So my blog is, I have not been very active on my blog, but adamhgrimes.com. I have many, many things planned there. So keep an eye on my blog. Also, my Twitter. I am at Adam H. Grimes on Twitter, and I tweet every blog post there. I also have a couple books you can find on Amazon, and you could check me out at marketlifetrading.com. We do have a pretty accessible trial that for people who trade U.S. listed stocks, options, or futures. Our focus is on the daily time frame, but it's a good way to see kind of one of the things that I challenged myself there. I do these daily market analysis videos, and sometimes they're short, sometimes they're a little bit longer, and I have never erased or edited anything. So you can go back, and I'm right a lot, but I'm also stunningly wrong at points. So, we leave all of those in the archives, but there are a few thousand videos. It's also a good personal diary for me. I can go back and see, our brains create these great stories and we think we're better than we are. And, I can go back and say, well, what exactly was I saying 2 weeks after COVID? What was I thinking? What was I telling people? And so, it's kind of also become a daily diary for me, and that's marketlifetrading.com. But I think just if you had to pick just one thing, Twitter's a good place at Adam H. Grimes.
Awesome. Well, certainly leave the links below the videos. People can check it out and connect with you there. And Adam, I appreciate your time here. I think it's been a good discussion we had. I look forward to catch up with you soon and
Always love
how you
talking
doing in
with
the
you.
future.